finance minister presented a budget which both debt and equity market treated differently. If you see the debt market, and when debt market yield goes up, it is considered negative, unlike in equity when index goes up, it considers positive. From the day of budget, yields actually shot up by 15 basis point, and post-budget, next day it kind of cooled down. And on the equity, day of budget markets went up and down, but were morely stable. But post-budget, it corrected big time. So how come same budget given to debt guys is different and equity guys is different? So one rational and logical explanation is that this time finance minister used Hindi and English. So equity guys are all smart, sophisticated. So they could understand English, they didn't know Hindi. So they interpreted in one way. डेट मार्केट वाले हमारे जैसे लोग आधे गवार, हम लोग को हिंदी समझ आया तो इंग्लिश छोड़ दिया, बट दैट इज नॉट ट्रू. हाँ, so in this budget there are certain contradictions. One contradiction was of populism versus prudence. The debt market thought that this budget is populist. You have given so much, spending that this will be overshot, fiscal deficit will be high, borrowing program will be high, and hence it is not good. The equity market took a positive view, saying that no, 3.3% is fine, you will be able to achieve, growth will come back. So debt market, once beaten, twice shy. Last year we suffered heavily. So they have taken a negative view of the budget. Equity market, last year we benefited a lot. So they have taken a positive view, and hence the same budget is being viewed differently by two sets of people. In this budget there were restrictions which equity market was able to appreciate. If we get 100 rupee of tax collection, 48 rupees goes in interest payment, then there is salaries, then there is defense, then there is subsidies. Effectively, finance minister doesn't have too much choice. The debt market guys were a bit more worried that, look, finance minister is not innovative. You targeted 1 lakh crore of divestment this year. Now next year, why are you coming down to 80,000 crore? And to fund that 20,000 crore, you are levying long-term capital gain tax. You could have been more innovative in raising targets rather than being chingus. So equity markets appreciated finance minister's limitation. Debt market appreciated lack of innovation from the finance minister. Lack of innovation versus creative. The finance minister wants to raise 20,000 crore from long-term capital gains tax. The finance secretary makes a comment that to earn capital gains, you don't have to do anything. एक बार निफ्टी ट्रेड करने आ जा, तेरे को पता चलेगा कितनी मेहनत पड़ती है. So there are this kind of amazing statements which has hurt debt market guys, saying that you are not creative enough, you are not innovative enough. For example, when a share is split, 100 rupee share into 10 rupee or 10 rupee share into 1 rupee, the cost is split. But when there is a bonus given, then the cost is not split. So we are the only country which allows this kind of provision where bonus share is treated as zero value. When I was doing my chartered accountancy 30 years back, at that time we were reading this case, CIT versus by Shirin by Kuka. It is still valid today, which gives bonus shares value of zero. If you see over last 15, 20, 30 years, every industrialist who sold his business and made capital gain didn't have to pay any tax because he could do bonus stripping and earn short-term capital less to adjust short-term capital gain. If you had plugged bonus stripping, you would have got 25 to 30,000 crore. There was no need to levy long-term capital gains tax. So debt market was worried that finance minister is not innovative enough. Equity market in their optimism gave the benefit of doubt, saying that finance minister, you are creative enough in estimating GST tax collection. हम लोग को तो नहीं दिखता आप इतना नंबर कहाँ से लेके आएंगे, बट आपको दिख रहा है तो विल गिव यू द मार्क ऑफ क्रिएटिविटी. The equity market looked at the representation in the budget. Finance minister gave money not from his pocket alone, but also from state government's pocket and also from government-owned enterprises' pocket. So when they talked about pumping X amount into rural, Y amount into agriculture, Z amount into something else, it's not only budget alone. They talked about budget plus state government plus other government corporations. The debt market looked at the real number saying that, sir, आप इतना बोल रहे हो, पैसा फंड कहाँ से करोगे? So again, market took a different view. At the end of the day, this budget gets 10 out of 10 on vision. The real issue is execution. And the track record of the government in executing certain projects are fantastic, but in many projects is not so good. Now, what's this vision versus execution? The first one is agriculture. This is the budget devoted to agriculture. One can say it is election budget and hence it is devoted to agriculture. One can also take a view that 70% of India lives in rural India, lives on agriculture, and it's time that we support them. Over last 10-15 years, farm income in real sense have actually come down rather than they have expanded. And how is government planning to do this? The roadmap is quite simple. You provide good MSPs. You provide connect between farmer and consumer, remove the middlemen. And I'm sure you remember those photographs of traders from Lasungaon, which is largest onion market near Nasik. In their house, they have charpais, which is made of silver. Very few of us will have a silver charpai in our house, but it is lying in their, row houses and bungalows. So you take the middlemen out, you try to develop futures and option market in agriculture, you provide soil card, you provide irrigation, blah, blah, blah. Now, some of these are executed, some of these are not. Outside of Mumbai in Vashi, we have APMC. It has 100,000 crore turnover. Now, normally you will expect that APMC Mumbai, where government of Maharashtra is BJP, government in Delhi is BJP, this would have been covered under ENAM, the digitization, where prices traded between farmers will be displayed on the screen. In reality, even today in APMC, if you go, farmers and middlemen are touching each other's hand, grabbing each other's hand, putting a rumal on it, and they are fixing the prices. We were told by one of the analysts that a 15 kg sack of cauliflower in APMC is sold at 70 rupees. You cross the bridge, come to Chembur and sell that same sack for probably 1,000 rupees. The gap between that 3 or 4 kilometers is 70 rupees versus 1,000 rupees. So the intention of the budget on improving agriculture is fantastic. The real question is how much of this will be executed. If we see soil card, if we see crop insurance, the track record is fantastic. But if we see dismantling market intermediaries, the track record is not so good. The second one is push on infrastructure. Railway, all-time high spending. Road, all-time high spending. So that's very good. Eventually it will benefit India. We are also seeing huge focus on affordable housing. Now, this budget, government has increased allocation to affordable housing by 30,000 crore. This is just the subsidy. So if this 30,000 crore is used to build affordable housing on state government land, then 11 million ton of additional cement will be demanded. 11 million additional demand of cement will also be backed up by similar demand in paint, tiles, fittings, and so on and so forth. Suddenly economy can do well. Now the real question is who will go and build these houses? Will there be enough contractors who can build the houses or not? So intention is in right place, execution is critical. The same thing is about investor confidence. Now, on the day of the budget, they said that there will be grandfathering of capital gains. Great. They didn't clarify it is applicable to foreign institutional investors also. Now, they have to give that explanation yesterday at 4 o'clock that it is applicable to foreign investors. Now, did yesterday's sell-off happen because FIIs were also selling because they were not sure whether they are grandfather or not? Who knows? Could we have not expected in the budget a clarification that grandfather is applicable to all the investors, be it domestic, be it local, be it global? So similar small things have dented investor confidence. If we behave nicely, if we deliver nicely, that confidence gets restored. If we don't, then there is problem. If you look at capital market development, for last 25 years, we have been importing gold. Our gold import is more than total foreign direct investment in India. That means we are sending capital abroad rather than retaining in India. Now, every time government speaks that we will do something on gold. In this budget also, they have said there will be a comprehensive policy on managing gold as an asset class. Great thought. But sir, 25 years से तो execute कुछ हुआ ही नहीं है ground के ऊपर. If you can mobilize $1 trillion worth of gold which is lying in some temple's vault or some bank deposit locker or someone's house, you don't really require any foreigner to invest in India. We have more than enough resources. Total FDI plus FII in last 25 years put together is just about $400 billion. And our investment in gold alone is almost $1 trillion. We monetize gold. We don't need any FII. We don't need any FDI from a capital point of view. From technology point of view, it's a different ball game. But from capital point of view, I don't need any foreigner. But again, the vision is great. Will there be execution? So effectively, budget is an event which has passed. Both markets have taken it kindly on one day and not so kindly on next day. Our feeling is that the volatility will continue going forward. And that's where we'll have to focus on larger economy. What's going to happen in economy over a period of time, that will determine where the markets will go. So the best way to explain this larger economy is a short story and a long story. If you get convinced with short story and you are all going to give your check in Kotak Mutual Fund, then I won't go to long story. Otherwise, I will bore you with long story. So recently I went to Japan. मेरा English उनको समझ में नहीं आया and मेरा Japanese भी उनको समझ में नहीं आया. So I had no option but to carry one chart which can speak for itself. So if you notice this chart, there is this white line which is crawling up steadily. And if you focus very hard, there are these small lines trying to come up barely, the red, yellow, and blue. This white line represents the price chart of Maruti since listing. Where do I have to? It doesn't want to come. The computer is Japanese. Yeah. So this is the price chart of a local company called Maruti Suzuki. And then I tried to compare small Japanese companies like Hondas and Toyotas and Nissans and Suzuki. And I told Japanese guys that, look, when you invest in Maruti, which is my company, you get 31% return compounded in yen terms for last 14 years. And then you add all your small cap companies like Hondas and Toyotas and Nissans and Suzuki. All of them combined don't deliver return equivalent to my small company called Maruti. So if you want to make money, come to India. If you're happy earning that 2-4% return, then stay with your small companies like Hondas and Toyotas. So this is the story of Indian equity. Now, as a fund manager, we have been always told that you should have plan B ready. Markets will never behave as per our prediction. So we must have an intelligent reasons to prove why we were not able to predict what market did. So I went with plan B as well. In Japan, there is a proverb which says that if you do not enter tiger's cave, you can't catch its cub. Now in Maruti's case, very recently a leopard visited them. He also wanted to buy Maruti Swift. They shut the production, tranquilized the leopard, and then went back to making cars. Now this adventure is not provided in Japan. In Honda's and Toyota's factory, they never get a leopard. Only we can provide this adventure. But if you can capture this adventure, then you make 31% return. So this is the story of India. Now can I have your check? So this is the long story. On the long story, many people think Mr. Modi has not delivered, the government is sleeping, blah, blah, blah. They don't really realize what are the issues. Now, before we come to the economy, let's first come to the market. Till day before budget, whenever this kind of meeting was happening, people were saying, Nilesh bhai, when will market crash so that I can invest into market? Now, with lot of hard work, I have brought market down. And abhi question yahi rehta hai. So, to all those people who believe when should market crash, when will market crash, and who think market is expensive and that's why they want it to crash, this is my question. What is this? A modern art, but it is worth $110 million. Now, if someone finds this not so expensive at $110 million, then how can you say Indian market is expensive? On a serious note, our markets are correcting because, one, it had become little bit expensive. It had not become very expensive, but little bit expensive. And if you remember, the newer message of Mr. Uday Kotak was that small and mid caps looks expensive and it's time to be cautious. He could not have timed it better than that. We did this analysis on Jan 16, 2018 to substantiate Mr. Uday Kotak's note. We realized that the large, mid and small all were trading at a different premium to their historical average. So if you notice large caps, they were trading at 10% premium to their historical average. Mid caps was 25% premium and large cap was 33% premium. Small cap, sorry. So this is where correction was necessary and this is where it is coming. This is where correction was warranted and it is coming. And this is where correction is coming in sympathy to small and mid cap, but hopefully it will not be substantial. If you look at Warren Buffett's thumb rule indicator, he uses market cap to GDP ratio to evaluate whether a country is cheap or expensive. We were 149% of GDP in 2008. Today, we are at about 96%. So we are not expensive, we are not bubble, we are not cheap. We are somewhere little bit around fair value. With some more correction, we'll come back to our historical level, and I think that's where market will stabilize for the large caps. The other thing which has happened in the market and which hopefully should continue post this budget despite levying of 10% capital gains is this. In the FY14 and beyond period, the FIs were the rulers of our market. Their behavior determined whether our markets will go up or go down. When Lehman Brothers expired in 2008, our markets reacted as if State Bank of India is going to die. State Bank of India was in a perfect situation. In fact, it was becoming better with the crisis. Yet, our markets corrected because of the FII over-dominance. And they were dominant because they were bringing so much flows into Indian market that whenever they stopped, our markets had to correct. But post FY 2014, slowly and steadily, we have started matching FIIs. Now, if you see our flows, it's multiple time FII flows. Earlier, if you wanted to sell an IPO, you had to go to Tokyo, London, Singapore, Hong Kong, New York, Boston, and so on and so forth. Now, if you have to sell IPO, you have to come to Bandra Kurla Complex, Nariman Point, and India Bull Center in Lower Parel. That's it, your IPO will be sold. This is the change which has occurred in our market, and hence we will be less volatile. If again Lehman Brothers expires today, we won't be going down as much as we went down in 2008, provided you continue to support mutual funds. So this is one big game changer which has happened. Now let's look at some of the economic challenges which we are facing. The first challenge of India is its diversity. We all know we are complex, we are diverse, but we don't know the range of this diversity. Our smallest state, Goa, has population of 75 lakh, which is equivalent to Estonia. The largest state, UP, has population of 23 crore, equivalent to Brazil. We have to run a country from Estonia to Brazil together. Very few person can do it. If this is not good enough, look at our per capita GDP diversity. The richest state, Delhi, has per capita GDP equivalent to Indonesia. The poorest state, UP, which is bigger, it has per capita GDP equivalent to Nepal. Now, when we think of Nepali, the first image which will come to us is Gorkha and Chowkidar. We must remember that there are 23 crore Indians who are poorer than those Gorkhas. Now, how do you manage this country? We are not a country, we are a continent. And to move this continent, to manage this continent is a big challenge. In fact, our biggest thing to FII is that whenever we meet a foreigner in US or Japan or Europe, we just ask them, "Sir, do you believe in God?" Most Goras says, "No, we are atheists." And then we give them the invite. "Sir, ek bar India aa jao, you will see us functioning, you will start believing in God." That's our best invite to get Goras into a Kotak Mutual Fund headquarters. The second challenge which we are facing right now is job creation. There are serious limitations in terms of creating jobs. The job addition into workforce is about 10 lakh youth a month. About 1.2 crore jobs needs to be created. Our actual creation might be just 30, 40, 50, 60 lakhs. So we are falling quite short of job creation. The third challenge is that today majority of my entrepreneurs are not looking to invest into business. The Tatas, Birlas, Ambanis are saying that if there is someone else who is willing to sell his assets, I'm happy to buy. But I'm not putting new assets at as much pace as I was putting in the past. And so many other guys, GMR, GVK, Lanco, Adani, SR, Anil Ambani Group, JSW Steel Group, JSPL Group, they are all managing their existing projects rather than setting up new projects. So effectively, capital creation, investment, capacity building, that has come down dramatically. Apart from this, there are some market challenges, and economic challenges obviously precede market, but market challenges also act as a drag on the market. The first challenge for the market is that Rajinikanth has decided to retire. Now, why am I linking Rajinikanth? I mean, Rajinikanth can do anything, but for equity market, we have different Rajinikanth. Those Rajinikanths are the central bankers of the world. In 2008, US was sinking. Citibank, Morgan Stanley, Bank of America, they were all falling like a 9-pin. And then what did Fed did? Fed simply started providing liquidity. And zoom, that liquidity has resulted into taking out all the subprime loans of the various banks. The ECB did the same thing. They also provided money to douse fires of Portugal, Spain, Italy, Greece. Bank of Japan has been doing this for last 20 years. Now all these central bankers has pumped $12 trillion, 6 times India's size in markets over last so many years. All of them are threatening to take away the liquidity. We have been brought up on the diet of central bank liquidity. Now we'll have to live without them. When our Rajinikanth will not be there to support us, how many of us will be able to deliver return? That's $1 million question. The second challenge is that oil prices have started moving up. Of course, they had fallen a lot and then they have climbed back. But our economy was factoring in this oil price, and now they have to factor in this oil price. Of course, they haven't shot up to here. It's still over here and they've started correcting. So we need to watch oil, where does it go? Third, there are state elections, and then there is mother election of 2019. Now, if you see the elections, they generally impact the market. In 2004, market believed India Shining campaign. It went up. Then they consolidated as there were some doubts. And the day they realized that it is left front supported government, markets corrected. It didn't wait for government to deliver anything. Just left front support was good enough for market to come down 20%. In 2009, it was reverse. Market kept on correcting because they were not sure whether there is any stable government post-election. It stabilized once it had fallen enough. And then it went up 20% in a day when they realized that Manmohan Singh government has come back with higher majority. 2014 was completely different. It was in some sense easier. It just kept on climbing up and up and up and up and up. In fact, the Sensex was nothing but expected number of seats to be won by BJP in 200. When it was 180 seats, it was 18,000. When it became 250 seats, it became 25,000. Now, what will happen in 2019? Will market go up like 2004 and then correct? Will it come down like 2009 and then go up? Or will it be like 2014 going up and up and up? Or it will be a new trend of 2019 where it's only going down and down and down. No one knows. There is already a talk of midterm election. So 2019 returns, portfolios, market, everything will be influenced by what happens to the election. And how does market discount it? And unfortunately here, there is no tool to predict other than Pandit Govindacharya Maharaj. You can consult him. Kotak Privy will provide a special discounting there. Beyond election, it is the earnings which drive the market. Now, earnings are notorious. They are cyclical in nature. Kabhi khushi, kabhi gum, kabhi khushi, kabhi gum. So we are expecting now there should be some khushi. Will it happen in that fashion? Answer is no. The earnings won't recover just because of cyclicality. There has to be some economical base. And we think there are a couple of reasons why profitability can go up. One, let's understand what has happened in the past. Between 2008 to 2017, corporate profitability has come down by 50%. Profit as a percentage of GDP was 7.1%. Today it is 3%. How come Indian businesses are losing money or they are making so less money? One, in 2008, no PSU bank was declaring losses. In 2017, every PSU bank started writing off NPAs and declaring losses. In 2008, telecom companies were making profit. In 2017, courtesy Reliance Jio, all telecom companies are losing money. So there are certain factors like NPA write-off and telecom losses. But even after discounting that, there is a drop in the corporate profitability. Businessmen of India are making less money in 2017-18 than they were making money in 2008. And that is straightway reflected into corporate earning. We think now these numbers will start going up. Why do we feel so? One, in earlier time, around 2010, 11, and even before, capacity utilization was 80%. With demonetization, with GST, with other factors, capacity utilization came down to 72%. If you utilize your plant less, your margins will get impacted. Now the expectation is that capacity utilization will start going up. Maruti is facing capacity constraint, Motherson Sumi is facing capacity constraint, Myco is facing capacity constraint. Many of the cement plants, albeit due to cartelization, are facing some capacity constraint. Many chemicals and specialty chemical plants are facing capacity constraint. So clearly capacity utilization will improve and that will result into better profitability. The second thing which is happening is that generally salaries and wages as a percentage of sales for top 5,000 companies was averaging between 8 to 9%. Now suddenly in last 3 years, it shot up to 11.5%. It's almost as if businessmen of India turn out to be Mother Teresa. They started paying more salaries to their employees at the cost of their profitability. For 25 years, I have searched for that kind of boss, and that's why I kept on changing job from ICICI to Prudential to Templeton. I didn't find one. So how come businessmen of India are becoming Mother Teresa? I don't think so. They are turning out. It is just a coincidence of GST demonetization coming together, which pushed their cost. They are retaining employees because they believe future will be brighter. And as we move into next couple of years, the salaries and wages cost will come back from 11.5% to 9% level. This will create better profitability for corporate India. We also expect two factors which has hurt Indian economy will get normalized. Now I want you to answer me this question. Intoxication. Whiskey plus water is intoxication, right? Gin plus water, intoxication. Ma'am, don't drink water, please. Rum plus water, intoxication. So conclusion is that if you drink water, you will get intoxicated. That's why I was warning you. This is right? Anyone has a dispute with this equation? No one. So all of you are qualified to become our RBI. In their opinion, low inflation of India is function of low oil prices but high rates, tight money but high rates, low growth but high rates. So if you keep high interest rates, inflation will be low. This is hurting Indian economy. If you see, government of India pays real interest rates of 3%. How many countries are there in the world where nominal interest rates are 3%? I recently visited Thailand for an official work, not for tourism. Their 10-year yield is 2.4% and their bank deposit rate is 2%. And then I came back to India to meet one of my cousin brother who is in gold jewelry business. And I was telling him that, look at Thailand yaar, वहाँ पे gold jewelry कितनी सस्ती बनती है. And then he gave the narrative and I was shocked. So when we entered into FTA with Thailand, when we imported gold into India, there was 5% import duty. But if you import gold jewelry from Thailand, there was no import duty. So my cousin was down by 5%. Second, when my cousin pays interest, he pays at about 12%. In Thailand, someone pays at about 4%. So he was down by about 12 minus 4, 8% plus 5% import duty. So 8 plus 5, 13. Over last 1 year, Thai baht has depreciated against Indian rupee by about 4%. So 12 plus 4, 16%. So unless until my cousin is 16% efficient versus his Thai competitor, he cannot make money in India. Now how do I make my cousin 16% efficient? Ease of doing business in India is legendary. It can add 5% negative, it can't take 5% out. So effectively, we lost our edge in gold jewelry business, diamond processing business to Thailand. So this real interest rates are hurting Indian businessmen quite dramatically. The second thing is rupee. Somewhere we believe strong country has strong currency and we has allowed rupee to appreciate. We think fair value of rupee as per various model is probably 68, 69 or 70, but it is trading at 63 and 64. Now what has this done? It is hurting our exports. It is allowing Chinese imports into India. And Chinese are really smart guys. So if you notice now, there is a stone exhibition in Bangalore. It's a very large exhibition. So one other cousin brother of mine makes cutting tools for cutting marbles. Now each marble in mines are different. So you have to make it handmade, you have to make it precise, tailor-made to that particular mine. This Chinese guys came to Bangalore a couple of years back and they imported cutting tools for exhibition in India. Now under our law, when you bring goods for exhibition in India, there is no import duty. So Chinese guys brought 3 container loads of cutting tools for exhibition. And when exhibition got over, 3 containers went back, but the cutting tools remained in India. And then they started this cutting tools at the price at which you can get it at scrap value. So my cousin just couldn't compete with them. So he came running to me saying that, Nilesh bhai, abhi to band bach gayi, kya karu? So my only solution is that instead of your buyers buying those cutting tools at scrap value, you buy it, melt it, and then sell it at the scrap and recover your money. Your competition will be finished. Now, how many of our manufacturers can compete with China like this? Today, our trade deficit with China is $60 billion. What is this $60 billion? You all know we have a very friendly neighbor called Pakistan. We are deeply in love with them. They are deeply in love with us. That's why they keep on sending some terrorist here or there to remind us. Pakistan is very close to China. Why are they so close? For a variety of things. But one factor is China-Pakistan Economic Corridor, which is a $60 billion infrastructure project. It is developing highway, telecom network, communication network, port, and so on and so forth. That $60 billion brings Pakistan's loyalty to China. And who finances China-Pakistan Economic Corridor? You and me. We import Chinese goods to that extent in just 1 year, which finances that entire $60 billion. If all of us stop consuming Chinese goods for 1 year and give that money to Pakistan, probably they'll really turn out to be a friendly neighborhood. That's the kind of impact this overvalued rupee is having in our economy. So if this rupee and rates normalize, and then operating leverage kicks in and salaries and wages gets rationalized, then no matter what happens to the budget, no matter what happens to global economy, no matter what happens to US dollar interest rates, equity markets will do well. As of today, do we have confidence on rates and currency normalizing? Answer is no. Was there early sign of exuberance in the market, and which is why this correction is coming? Answer is yes. One, I'm sure all of you were receiving tips to buy Sai Baba, Computrade, Sun Reality, and so on and so forth. Those SMSs were worth putting on auto delete. Second, you would have seen how IPOs were getting oversubscribed 100 times, 500 times, 1000 times. All the IPOs were not necessarily of great valuation. They were all good companies, but not necessarily at fair valuation. Third, there are second and third tier stocks which were running up. There was one particular IT company which went up almost 70-80% last year, and that pushed our fund underperforming benchmark indices. And every time we looked at that company, we couldn't convince ourselves to buy it. And I had to tell my fund managers, bhale underperformance aaya, but usme invest mat karna. Now, fortunately, in last 3 days, our underperformance is over because that IT company corrected by 40%. But this is the pain which was there in the market to be adjusted for. And if you can bear that pain, or if you can live that momentum, then probably market was fine. The most important thing in market was lack of volatility. The markets on the equity side last year were so less volatile that it kind of gave complacency to investors. I think this year all those things will be behind us. Markets will become more volatile. They have already shown a trailer. And depending upon the election outcome of 2019, we could see volatility in the market increasing. So this was the early sign of exuberance. We needed to overcome it. This correction is healthy, especially in small cap stocks, SMS stocks, mid cap stocks. But we think eventually if we deliver on the currency, rates, operating leverage, and salaries and wages rationalization, then profitability will come back. And with that profitability, market will get supported. And all of you need to brace for volatility in 2018. But if you can manage this volatility, then hopefully equity markets over 3-4 years will still deliver better return than fixed income, then real estate, and then gold like of commodity. Happy to take your questions. Yeah.
The conflict between the micro and the macro, very good in terms of operating leverage, higher profitability. Uh, where do you see the markets headed, and how should an investor place himself going forward?
So you have very correctly brought the yin and yang of our market. Last year, 2017 was good macro but bad micro. Corporate profitability remained depressed, but oil was down, rates were down, current account deficit was down, fiscal deficit was down. 2018 is exactly opposite. Companies are giving results which are great one by one, but crude is up, rates are up, fiscal is up, current is up. So this is the yin and yang of the market. If you pick up right stocks, you should be able to manage the volatility. If small and mid caps have corrected 20-30%, the large caps will correct 5-10%. Not that they can stay away from the correction, they will correct, but over a period of time, they will correct less and their bounce back could be higher. This is the year of volatility. The best way to overcome volatility is either increase your investment horizon or we increase our allocation based on volatility. Let's look at as a pure thumb rule, and this is pure thumb rule, so don't hold me accountable to it. We take 9,000 Nifty, 9 to 10,000 Nifty, 10 to 11,000 Nifty. So 10 to 11,000 Nifty, let's say my equity allocation is 40% or 50%. Then whenever Nifty is between 10 to 9, I will make it from 40% to 50% or from 50% to 60%. And whenever it is below 9, I will make it not increase by 10% but by 50%. So if I was 40 at 10 to 11, 50 at 9 to 10, below 9, I will make it 65%. And like versa. So if it goes up, I will take some profit out. If it is going down, I will add something more. And I will maintain this core and satellite. Core will remain 40%. The satellite will be plus 5, minus 5, plus 10, minus 10. That combination will help you ride this volatility.
Sure.
And that will be probably the best way.
Sure.
So one is long-term investments. I don't really care for volatility. We have seen enough times in the past where market goes down 30-40%. But over a period of time, it has delivered the return. Second is to consciously participate in the volatility by bearing the pain and increasing allocation and decreasing allocation only on the satellite part, not on the core part, to benefit from the volatility.
Sure.
This combination hopefully will deliver better outperformance.
So secondly, this LTCG, maybe you can call it confusion or good in the long term. How will this change the behavior of investors in the short term till March and after in the longer run?
So the informed investors will figure out that this LTCG is irrelevant. If you pay 10% LTCG today versus pay it, let's say 30 years down the line, and I'm taking sufficiently large year to point out something. Let's say you are making 15% compounded return. Now this itself is a very, very optimistic assumption because to make 15% in 1 year is always easy, but to make 15% over 30 years is always tough, but we are doing only mathematical calculation. So on 15%, when I pay 10% tax, my return comes down from 15 minus 1.5, 13.5. But if I defer that tax up to 30 years, then my overall return from 13.5 goes to 14.6. So by deferring my taxation, I'm able to reduce the impact of tax on my portfolio by almost 50%. From 13.5, I go to 14.6. From 1.5, I reduce that 10% impact to only 0.4% despite paying full tax. So most informed investors will prolong their investment horizon to avoid taking the hit of long-term capital gain on their portfolio. On the other hand, there will be some immature investors who will say, शॉर्ट टर्म में 15, लॉन्ग टर्म में 10, तो 5% के लिए कौन इतनी माथा जिक करे, बिंदास ट्रेड करते हैं, सट्टा करते हैं, खेलो इंडिया खेलो चलाते हैं. Those guys will suffer heavily. My guess is that in the market there is more mature money than immature money. but there is some immature money that we cannot deny. So it is a fight between mature money versus immature money. My guess is that long-term capital gain will become irrelevant. The second thing which we need to be aware, that many FIs today were not paying tax. Now they have to pay 10% tax. So if I was willing to buy something, let's say at 18p, because I was expecting X amount of return on 18p, now that return comes down by 10%. So logically, maybe that 18 will become 16.2 because I will discount it by adjusting for the taxation. Now, will people adjust exactly 10%? Who knows? Some might adjust 5%, some might adjust 15%. So there will be general derating of PE ratio from an FII point of view in a perfect world. Now, our problem gets compounded because there is Japanese investors whose return expectation starts at 0%. And then there is Middle Eastern investors whose return expectation might be 5%. And there will be some American, some European whose will be different. So we just need to be keeping at the back of mind that there will be some derating of India because of the taxation. It won't be material, not exactly 10%, but there will be marginal derating, which is what is reflected unconsciously in the market correction.
Thank you.
It was Dow's no confidence motion on Indian budget.
Stock markets don't perform the same way.
Yes.
Because people move money outside and there is FI money in
Yes.
India to a large extent. So do you see that
So
having a big effect?
that is the biggest challenge, and that is what we mean by Rajnikant. All along, our performance is supported by Rajnikant in the background. Now we'll have to perform on our own. We won't have Rajnikant's support. But if we take a longer term view, see, the world economy has moved from ICU to general ward. And the bankers are saying that we want to move it out of hospital. We give a lot of steroids to stabilize person. Now he is in general ward, courtesy those steroids, and we need to take that out because eventually there could be crippling effect. But if I take out steroids in one day, the guy will come back into ICU. So we depend upon the capabilities of this doctor to take out steroids in a gradual, calibrated manner so that the patient goes out of hospital rather than goes back into ICU. That is our one respite. Second, at the end of the day, out of this $12 trillion, we have received probably $100 billion, $120 billion, $150 billion. It is not $1 trillion. So if I remain attractive enough vis-a-vis my next competitor, I can still continue to retain $120 billion. Or if I become super attractive to my next competitor, I can get another $100 billion. So can I remain more attractive? In Japan, earlier when we used to go, we used to sell India. And then Kotak Mutual Fund was in last line. Now, invariably, those distributor and client ask, "Boss, India chhod do." You talk about Kotak Mutual Fund, we know everything about India. And normally when we travel, we are a little bit lazy, so we don't read emails. These Japanese distributors were asking questions for the yesterday's data and today's data. So I had no option but to get up early in the morning at 4 o'clock, read all my emails, prepare myself so that I can answer those buggers. Those distributors are more cruel compared to Indian distributors. Indian distributors don't harass us by asking yesterday's data. They have become so intelligent about India. So hopefully if I can maintain that image, then we are home. The third thing is that if I can monetize gold. See, gold is our pain. If I can monetize 10-15% of that, it will help me manage Rajnikant's withdrawal. Now, will we do all three these things together? Of course not. But even if we do partially of all these three, we'll be able to manage this thing. But this is the most difficult and tricky situation. If I can manage political equation in 2019, and if I can manage central bankers tightening versus loosening at various points of time, then I will deliver great return. If I go wrong on both the sides, next time they won't invite me here. I showed you intoxication. So in debt market, what has happened today that there is one, a market breakdown, and second, a fundamental breakdown. So in the past, when government's borrowing program used to go up, many a times RBI used to intervene and manage. So earlier we had RBI like Krishna Bhagwan. He was given the chariot of Mahabharat. And because this is Kalyug Ka Mahabharat, the chariot had 4 different horses in 4 different directions. And he was supposed to move the chariot. So we mandated RBI ki dekh bhai currency sambhal ke rakhne ka. Then we said, boss, interest rate bhi sambhalne ka. Then we said, growth bhi sambhalne ka. Then we said, banking system bhi sambhalne ka. Now, these were all conflicting objectives. You want to control inflation, you have to raise interest rates, government's borrowing cost goes up, growth comes down. Then you go and support growth, inflation goes out of hand. You manage currency by raising interest rates, inflation takes hit. So there were all different conflicting objectives, but RBI was no Krishna Bhagwan manage kar leta tha. Then we realized कि अभी Krishna Bhagwan का क्या जरूरत है? Let's have Arjun. So Arjun could only see the eye of the bird. So we have mandated RBI कि आप खाली inflation 4% control करो, बाकी सब तो वैसे ही manage हो जाएगा. Now RBI is managing inflation and they are not managing other things. This is a transition. It's not that RBI has given up on all those objectives, but the priority has changed. Now the equation needs to stabilize. Today that equation is taking time to stabilize, and in the process there is a market breakdown. Most of the PSU banks carry SLR. Their SLR is government securities. It's now about 28-29%. The statutory requirement is, I think, 20% or 21%. So they have excess SLR. When demonetization happened, all of us put our money into bank. Where will bank go and put their money? They had no option but to buy government securities. So they bought government securities. So they had excess SLR. On top of it, they built excess SLR. And then recently RBI said that who told you to buy government security? You have so much of excess SLR. Don't you understand? Now bankers are saying, fair enough, we'll sit out of the market. The biggest player of the market is not playing. It's like Virat Kohli getting angry when people said, oh, you don't know how to play cricket. So bola, theek hai, teesri test mein tum log jaake khelo. The commentators came to play cricket. What would have happened? The same thing is happening in debt markets. So interest rates have gone up because there is breakdown between Krishna to Arjun transition, because players are not playing, they are sitting out. So from a fundamental point of view, 7.6% on a 10-year yield is very, very attractive. If I look at US Treasury at 2.8 and I'm rounding off versus 7.6, we are way above US Treasury. It's above our historical spread. So even if US interest rate goes up 3%, no worry on 10-year India yield. If I look at my repo rate at 6, 760 is 160 basis point higher, very, very attractive to enter. So fundamentally, this is the level to invest in fixed income. Technically, because this transition is happening, because there is no communication, it's probably going to remain a little bit more volatile for some time to come. All our life we have said, please invest through SIP in equity funds. Now time has come to say, please invest via SIP in fixed income funds because of this volatility. Last year, our fixed income funds at one point of time delivered return less than Kotak Bank savings account, 6%. We were happy. Then we graduated to delivering 3.5% return less than the PSU Bank savings account. And as I speak today, I have delivered return lower than the current account of bank accounts. We have given negative return. So this trend won't continue in calendar year 2018. I will definitely improve upon all this. At some point of time, my returns will be better than current account, then 3.5% savings bank account, then hopefully 6% Kotak Bank account. But will it happen in a hurry? Answer is no. This short-term volatility, which I explained by virtue of intoxication equation, that needs to change. No, sir. Keep money in Kotak Midterm Fund, which is Credit Opportunity Fund. That fund has delivered better than Kotak Savings Account. That's why I'm standing here. Otherwise, I will be standing outside. Uh, so, when you are in dividend plan, your grandfathering happens at 31st Jan prices. But every time there will be dividend declared, you will pay 10% tax. So let's assume you invested at 10, the NAV shifts to 30. And then from that 30 rupee NAV, dividend is paid. In the growth plan, 30 becomes your grandfathering, so you don't care about tax. But in dividend plan, if I declare, let's say 20 rupees of dividend on 1st April, you will straight away lose 2 rupees by virtue of dividend distribution tax, even though it should be grandfathered. So it will be important for you to make the switch before 31st of March between dividend plan to growth plan, and then put systematic withdrawal plan if you need dividend, so that this dividend distribution tax doesn't hit you.
And what should we do about the inherited shares stocks? Should we sell it before
No, all the shares which you have inherited will be grandfathered as of 31st of Jan, including bonus shares, including every other shares. The only doubt remains open on unlisted shares. In listed shares, grandfathering is visible on 31st Jan NSE BSE code. But if you have unlisted shares, then you don't know whether that will be grandfathered or not. So you need to consult your CA about the unlisted shares. For listed shares, there is no worry. For those guys who have employee stock option on which STT has not been paid, you probably are better off doing the transfer before 31st of March. In the past, they had specified that even though STT was not paid on ESOP, it will be tax exempt. But in this budget, they have yet not made that clarification. I'm sure that clarification will come. But why take the chance? Might as well book the profit before 31st of March and reinvest in the same shares if you want. If that clarification comes through, then you can avoid it. But if that clarification doesn't come, then it's worth doing it.